Hi there. In this week's insight into what's moving the market, we're looking at companies with high CDS spreads, and we're looking at the short selling behavior in the equities of those companies. So we've decided to focus on the North American High Yield Index, CDX Index, which is an index of the 100 most actively traded companies with non-investment grade credit. And if you look at over the last 2 years, the average spread that this index is trading at is actually decreased quite significantly. So it shows you that as central bank intervention and the market calmed, we've seen the CDS spread come way down. Now, as far as the equities portion of that, equity investors are a lot more bullish about what's going on in these names as well. So the constituents have seen their average short interest decrease quite significantly over the last 2 years, if you can see from this chart here. Now, obviously this is quite an interesting development. And this was mostly led, we found out, by the heavily shorted names. So companies which a lot of short sellers thought were, heading towards bankruptcy and so on. So quite significant restructuring have actually managed to turn themselves around. So if we look at the most shorted names, they've pretty much seen across the board short covering. So leading the charge, we found that SuperValu, which is a US grocery store that had very serious questions asked about its survival potential a couple years ago, has since been able to restructure quite well. And what we've seen is the shareholder, the short sellers come way down in that name, is down over nearly 90%. And what we've seen is the share price has done quite well. So just to give you an indication that CDS and short sellers, short interest do move kind of in step with each other. And so there is this perceived notion that as credit becomes perceived as less risky, so did the equity portion, and we see short covering. So definitely encourage you to look at the full report. But thank you very much, and have a nice week.